Alright folks, buckle up, because today, May 31st, 2025, the crypto market decided to do its best impression of a Six Flags roller coaster. You know, the one that drops you so fast your stomach ends up in your throat? Yeah, that one. We just saw a staggering $208 million, that's million with an M, wiped out, vanished. Poof! Gone in 60 minutes, 1 hour. That's less time than it takes to decide what to watch on Netflix. Think about that. Your life savings or someone's could just evaporate while you're scrolling. Now, $208 million. That's not chump change, that's buy a private island money. That's fund a small nation for a bit money. And it all got flushed down the digital drain in the crypto markets. Imagine the chaos, the screams, the sudden desperate need for a very strong cup of tea, or maybe something stronger. This wasn't just a dip, people. This was a full-blown, code-red digital fire sale where the sellers weren't exactly willing. It's the kind of event that makes headlines and probably gives a few financial regulators a serious headache. This kind of volatility, this financial whiplash, is sort of crypto's signature move. It's like its party trick. Hey, look how I can make $250 million disappear. Ta-da! And everyone who's been in the game for a while just nods, a little pale, and says, yep, that's crypto for you. But for newcomers, or anyone with a significant chunk of their hopes and dreams tied up in these digital coins, it's a brutal reminder. A very expensive, very public reminder. So, what happened? Was it aliens? A rogue AI finally deciding to mess with our finances? Or just the usual crypto craziness dialed up to 11? We're going to unpack this. We're going to look at the digital entrails of this financial beast, because understanding this madness is the first step to maybe, just maybe, not getting caught in the next inevitable crypto earthquake, or at least having a helmet ready. Stick around, it's gonna get wilder. Okay, so you heard liquidation. Sounds serious, right? Like a business closing down, everything must go. In crypto, it's kind of like that, but for your trading account, and it happens way faster. Imagine you're betting on a sports game, but you borrowed money from a very impatient friend to make a bigger bet. If your team starts losing badly, your friend doesn't wait for the game to end. He snatches back his money plus whatever you put down, just to cover his loan. That's liquidation in a nutshell, crypto style. In the fancy world of crypto trading, especially when you're using something called leverage, we'll get to that monster later, you're essentially borrowing funds from the exchange to make a bigger bet. I'm so sure Bitcoin's going up, I'll borrow 10 times my money to bet on it. Bold move, champ. But if the price goes the other way, even a little bit, your initial investment, your margin, might not be enough to cover the potential loss on that big borrowed sum. The exchange isn't your buddy, it's a business. When your position sours faster than milk in the Sahara, the exchange steps in, automatically, forcefully. They close your bet, they sell your assets. Poof, liquidated. This isn't a gentle tap on the shoulder saying, hey, maybe reconsider. This is a digital bouncer throwing you out of the club because you can't cover your tab, and your cool jacket is now theirs. It's brutal, it's swift, and it's a core feature, not a bug, of leveraged trading in these volatile markets. So, when we say $208 million was liquidated, it means hundreds, maybe thousands of traders had their positions forcibly closed by exchanges. Their bets went south, and the exchanges pulled the plug to limit their own risk. It's a safety mechanism for the exchange, but for the trader, it's often a catastrophic loss. It's the market saying, game over, try again later, if you have anything left, which after a liquidation many don't. Ouch. Now let's talk speed. 60 minutes, 1 hour. That's the time frame for this $208 million financial bonfire. Think about how quickly that is. You could start boiling an egg, get distracted by a squirrel, and by the time you remember the egg, a fortune has been wiped off the crypto map. This isn't your grandpa's stock market where things might slide over a day or a week. This is crypto, where fortunes are made and lost at the speed of light, or at least at the speed of a really fast internet connection. The rapid nature of these liquidations is due to a few things. First, the crypto market never sleeps. It's 24/7, 365. There are no opening bells or closing whistles. Trades happen constantly across the globe. So when a big price move starts, it can gain momentum incredibly fast, like a digital avalanche. Algorithms, or trading bots, often programmed to react to price changes instantaneously, can accelerate these moves, buying or selling huge amounts in fractions of a second. Humans can barely keep up. Then, you have the cascading effect. Imagine one big trader gets liquidated. Their forced sale pushes the price down further. This triggers the liquidation of another trader whose sale pushes the price down even more, and so on. It's like a line of dominoes, each one knocking over the next, creating a chain reaction of forced selling. This is how a relatively small price movement can suddenly turn into a massive liquidation event, all within that 60-minute window. It's a brutal feedback loop. So, when the market started to turn, and those initial positions got liquidated, it set off a chain reaction. The system is designed for this kind of ruthless efficiency. No human intervention, no, are you sure? Pop-up. just cold hard code executing trades and closing positions. It's what makes leveraged trading so risky. The speed means you have almost no time to react, to add more funds, or to change your strategy. Blink, and you could be liquidated. That's the harsh reality of this high-speed financial game. So, who got caught in this $208 million digital tsunami? Turns out, the vast majority were longs. Now, in trader lingo, going long means you're betting that the price of an asset, say Bitcoin or Ethereum, is going to go up. You're an optimist. You see sunshine, rainbows, and Lambos on the horizon. You're buying now, hoping to sell later at a higher price. It's the classic buy low, sell high dream, just supercharged with crypto's infamous volatility. The fact that most of the liquidated positions were longs tells us a crucial story. It means that a lot of traders were super bullish. They were all in on the idea that prices were heading to the moon. They probably saw some positive signs, maybe some good news, or just got caught up in the general hype that often surrounds crypto, so they placed their bets, many using leverage to maximize their potential profits, all pointing in one direction, up, up, up. But the market, as it often does, had other plans. It decided to take a sharp nosedive instead, and when prices fall sharply, all those optimistic long positions suddenly find themselves deep underwater. The value of their holdings plummets, and if they use leverage, their losses are magnified. The dream of selling high turns into a nightmare of being forced to sell low, very low, by the exchange, just to cover the borrowed funds. It's a brutal wake-up call. This dominance of liquidated longs isn't uncommon in these types of flash crashes. It often signifies a market that was perhaps overly optimistic or over-leveraged, as the pros say. Too many people making the same bet, often with borrowed money. When the sentiment shifts or a big player decides to sell, the house of cards can come tumbling down very quickly. It's a painful lesson in market dynamics. The crowd isn't always right, and betting with the herd can lead you right off a cliff. Section 5. Who pulled the rug? Unmasking the crypto carnage culprits. So, the big question, what actually caused this $208 million meltdown? Was it one specific thing? A shadowy villain stroking a white cat in a volcano lair, pressing a big red dump button? Probably not. Though with crypto you can never be entirely sure. Usually these events are a cocktail of factors, a perfect storm of bad news, market mechanics, and maybe a dash of panic, all mixed together. One common trigger is a sudden sharp price drop in one of the major cryptocurrencies like Bitcoin or Ethereum. These big coins are like the Gandalfs of the crypto world. When they move, everyone else tends to follow. So, if Bitcoin suddenly sneezes and drops 5%, other smaller coins might catch a full-blown flu and drop 15 to 20%. This initial price shock can be enough to start triggering those leveraged liquidations we talked about, especially for traders who are already close to their margin limits. Then there's the news factor. Unexpected bad news can send shivers down the market's spine. Think regulatory crackdowns from a major government, or a big exchange getting hacked, or even a prominent crypto influencer suddenly saying, "Actually guys, I'm out." Anything that spooks investors can lead to a sell-off. Large sell orders, sometimes called market dumps, perhaps by a whale, a big holder of crypto deciding to cash out, can also flood the market, overwhelming buyers and pushing prices down rapidly. And let's not forget the cascading liquidations themselves. As we mentioned, once the first few big dominoes fall, they can trigger a chain reaction. Each liquidation adds more selling pressure to the market, pushing prices lower, triggering more liquidations, and so on. It's a self-feeding monster. So while we might not be able to point to a single culprit, it's usually a combination of a significant price move, amplified by leverage, and then accelerated by automated systems and herd behavior. The result? Carnage. Section 6. The domino effect, how one big splash can cause a market tsunami. We've touched on it, but let's really dive into this domino effect, or, as the finance nerds call it, cascading liquidations. Imagine you're at a crowded concert, right? And one person near the front stumbles and falls. They might knock over two people. Those two might each knock over a couple more. Suddenly, you've got a whole section of the crowd on the ground, all because of one initial stumble. That's essentially what happens in the crypto market during these liquidation events. It's a human, or rather, a digital pileup. In crypto, the stumble could be a large sell order, a sudden price dip, or even just a rumor. This initial event forces some leveraged traders into liquidation. Their positions are automatically closed, meaning their crypto is sold off. This sudden influx of sell orders pushes the price of the asset down further. Now, here's where the next domino falls. Other traders, who were perhaps a bit safer but still leveraged, now find their positions are also in danger because the price has dropped again. So these traders also get liquidated. More forced selling. Price drops more? See the pattern? It's a vicious cycle. Each wave of liquidations creates the conditions for the next wave. It's like a snowball rolling downhill, getting bigger and faster. This is why a relatively contained issue can escalate into a market-wide bloodbath, like our $208 million event, so incredibly quickly. The interconnectedness and the speed of automated trading systems pour gasoline on this fire. This domino effect doesn't just hurt the people getting liquidated, it creates massive volatility across the board. It makes the market incredibly unpredictable and dangerous for everyone involved, even those who aren't using high leverage. Prices can swing wildly, making it difficult to trade rationally. It can scare off new investors and shake the confidence of existing ones. That's why these large-scale liquidations are such a big deal. They're not just isolated incidents, they're tremors that can shake the entire crypto ecosystem. Section 7 Leverage, crypto's high-stakes gambling pal, handle with extreme care. Okay, let's talk about the L word. Leverage. It sounds cool, right? Like having a lever to lift something really heavy. In finance, it means using borrowed money to increase the potential return of an investment. So if you have $100, but you use 10 times leverage, you're effectively trading with $1,000. If your bet goes right, and the price moves up 10%, on your $100 you'd make $10, but with 10 times leverage, on that $1,000 position, you'd make $100. Wow, you just 10 times your profit on your own capital. Genius. Hold your horses, Warren Buffett, because leverage is a double-edged sword, a very, very sharp one. Yes, it can amplify your profits, but guess what? It amplifies your losses just as spectacularly. Let's go back to that 10 times leverage example. If the price moves against you by just 10%, your $1,000 position loses $100. And since you only put in $100 of your own money, your margin, guess what? You're wiped out. Your entire initial investment is gone, kaput. With just a 10% adverse move, some crypto exchanges offer insane levels of leverage. We're talking 20 times, 50 times, even 100 times, or 125 times. With 100 times leverage, if you have $100, you're trading with $10,000. If the price moves in your favor by 1%, you double your money. Amazing. But if it moves against you by just 1%, you're liquidated. Your $100 is gone. 1%. Some cryptocurrencies can move that much while you're blinking. It's less like investing and more like playing Russian roulette with your rent money. This is why events like the $208 million liquidation happened. Many of those traders were likely using high leverage. They were betting big, hoping for big returns. But the market twitched the wrong way and boom, the higher the leverage, the smaller the price movement needed to trigger a liquidation. It turns trading into an extreme sport. Thrilling maybe if you win, utterly devastating if you lose. And in crypto, the market often has a cruel sense of humor. Section 8, School of Hard Knocks, Crypto Edition, Lessons from the Liquidated. So, $208 million just went poof. That's a lot of expensive lessons being learned the hard way. What can we, the humble observers, or maybe not so humble survivors, glean from this crypto carnage? The first and loudest lesson is practically tattooed on the foreheads of the liquidated. Leverage is fire. Use it carefully or you will get burned. It's not a tool for beginners. It's not a shortcut to riches. It's a professional-grade risk amplifier. Another key takeaway, the crypto market is, and likely will remain for some time, incredibly volatile. Prices can swing wildly, often without any clear reason. Trying to predict short-term movements is like trying to predict which way a fly will buzz next. It's chaotic. This volatility is precisely what makes leverage so dangerous. If you're going to swim in these choppy waters, you need a life raft, a plan, and maybe a very good therapist on speed dial. Risk management isn't just a fancy buzzword, it's your best friend in crypto. This means not investing more than you can afford to lose. Seriously. If losing that money would make you eat instant noodles for a year, don't put it in crypto, especially not in leveraged trades. It also means using tools like stop-loss orders, which automatically sell your position if it drops to a certain price, limiting your potential losses. It's about playing defense, not just offense. And finally, a bitter pill to swallow, FOMO, fear of missing out, is a terrible financial advisor. Seeing others post huge gains can make you want to jump in head first, often with too much risk. But chasing pumps or blindly following hype is a recipe for disaster. Do your own research, DYOR, as the cool kids say. Understand what you're investing in. Be patient. The market will always offer opportunities, but it will also always offer ways to lose your shirt if you're reckless. Section 9. Playing it cool in the crypto casino. Tips to not lose your shirt, literally. Alright, so you've seen the carnage, you've heard the horror stories, but maybe you're still crypto curious. Or perhaps you're already in, and you'd prefer your portfolio not to resemble a crime scene. How do you navigate this digital Wild West without getting financially scalped? First things first, education. Learn. Understand blockchain. Understand the specific cryptos you're interested in, understand market dynamics. Don't just throw money at cool-sounding coin names. That's like picking stocks based on which logo you like best. Next up, and this is a big one, start small, especially if you're new. Don't yeet your life savings into Doge Elon Mars coin just because some dude on TikTok said it's the next big thing. Dip your toes in, invest an amount that, if it vanished tomorrow, wouldn't ruin your day, week, or life. Consider it expensive tuition for the University of Crypto. You'll learn more by actually participating even with small amounts than by just reading about it. But keep the stakes low while you're learning. Diversification. You've heard it for stocks, it applies to crypto too. Don't put all your digital eggs in one basket. Spreading your investment across different types of crypto assets can help mitigate risk. If one coin takes a nosedive, hopefully, others in your portfolio won't follow it down quite so dramatically. Also, consider what percentage of your total investment portfolio crypto should even be. For most people, it should be a smaller, speculative portion. Not your retirement fund, please. And finally, the golden rule of not getting liquidated if you do decide to dabble with leverage, which, again, for most people is a bad idea. Use low leverage and set stop losses. If you absolutely must use leverage, treat it like a very spicy condiment. A tiny bit goes a long way. And a stop loss order is like an ejector seat. It might not be a comfortable landing, but it could save you from a total crash and burn. Stay skeptical, stay informed, and try not to let greed or panic drive your decisions. Good luck, you'll need it.